Yes, so absolutely. So when markets have bounced back from the April lows, valuations have caught up, especially when you look at the mid and small cap segments. Valuations, if you look at vis-a-vis its long-term average multiples on a one-year forward price to earnings, multiples are, at a almost 20 to 40% premium for mid caps and small caps respectively. For large caps, it is at a slight premium to long-term average multiples. And hence, yes, valuations have caught up. And in that context, as we were saying, risk reward is more favorable for large caps as compared to mid and small caps. For the next leg of multiple re-rating, clearly earnings trajectory has to improve. FY25 was a muted year for corporate earnings. Nifty earnings was mid-single digit. Expectations of FY26 is of double-digit earnings growth for the Nifty, which is the large cap index. If earnings trajectory does improve, and remember we do have a favorable base, rural demand is starting to show signs of improvement and policy support. So therefore, the biggest catalyst in our view for the markets, apart from flows and sentiment, would be the earnings trajectory for corporate India.
And, right at the top in the setup for you, we mentioned of course, the currency factor in all this as well. And we've got, of course, the dollar getting a leg higher versus the Indian rupee, given the oil price related concerns as well, Shibani. So how does that impact the equity side of the story?
So absolutely. So currency does have a role to play, especially as far as, the FII flows are concerned. As we were mentioning, India, of course, is not an island, and therefore India does get impacted with what's happening geopolitically, as well as movement in oil prices and the like. So to that extent, when we look at our currency markets, the couple of factors today, when you look at the current account deficit on a more fundamental basis, current account deficit is fairly well under control. RBI does have a large forex reserve, which they can utilize for managing currency volatility. Having said that, given that geopolitical tensions are abound and there is uncertainty on trade and tariff, it is likely that the buyers for currency would remain on the depreciating side. But there are enough tools from a policy perspective to manage significant volatility as far as currency goes.
And is there any sectorial breakdown that you can give us? Avoid certain stocks because of the, of course, oil as well as currency environment that we're in India, and these are the sectors that you really prefer?
Absolutely. So our preference has been towards sectors which derive demand from the domestic economy. Our belief is that given what's happening globally in terms of trade, geopolitics, as well as slower growth, India, from a growth perspective, still stands out and continues to be among the fastest growing large economies of the world. And therefore, sectors that derive demand from domestic economy are better placed. In that context, segments such as banking and financial services, which gets support because of the policy side, as we were discussing. And the second segment is discretionary consumption, which again gets a boost because of the policy initiatives, both monetary and fiscal. These are some of the segments that we are positive on. Where we are, cautious, of course, are segments which are more global in nature, commodities and the like. And therefore, from a portfolio tilt perspective, more bias towards domestic facing sectors such as banks as well as discretionary consumption.